the opposite of what Jim asked. What do I do if I got in this situation and the stock just ran on me? I said, okay, I think, hey, Tesla's popped up above the 20-day moving average again. It started to show a really positive MACD, which actually came up a couple times with my bull put credit spread search. You see it right there, that positive MACD around the 17th, the break, and on the 20th when it's right above the SMA 20. And then it just, shot up here. Whatever your thoughts are on Tesla, whatever your thoughts are on the stock. What could I do if I had bought the stock actually at 190 right now and it's up at this price? What can I do should I just close? I mean, heck, you've got like a 25, 26% gain. Should you just close the position? Should you start selling calls against it? But it's such a big run. Do I want to cap the upside? Well, that was one of the other tools we were talking about in the signature tools tab. Is the opposite. Instead of the stock repair, I have a stock that's dropped. I need to repair it, find a way to get back to break even faster. What if I have a stock that exceeded my expectations? Got in 10, 12, 15 days ago again at that price of 190. So what this tool does is the opposite. What it's going to show me is what puts could I buy on this position to help lock in some, most, or maybe even all of the unrealized gain on the position. Well, I'm going to leave it at all expirations for now. It's going to show a lot of weeklies up front. So in this situation, we got into Tesla, theoretically, not a real position, at 190. The stock's trading at 251.52. Got an unrealized gain of 61.52 of 32.4%. Normally, we might just close the position, take that after 10 days, and be very happy with our annualized return. But are we always going to get 32.4% in 10 days in the market? Probably not, but we can sure try. But again, what can I do now? Now, right away, I'm not going to be able to lock in all of that profit, I understand. But we see several positions here with our stock trading at 251. If we bought, let's just say 21 days out, the July 275 put for a price of $31.38, expensive if I had 100 shares, is another $3,000. And it would increase my cost basis to $221.38, my 190, plus the $31.38 for this 21-day put. But it's a 275 put. I'm guaranteed to get 275 back. So I'm guaranteed 24.2% of the unrealized profit over the next 21 days. It's a bulletproof position. The stock, Tesla, could fall back down to 150. I'm guaranteed to make 24.2%. It cost me $3,000 against 100 shares to do that, 3,100. But I'm guaranteeing myself a locked-in profit on the position that cannot lose. Now, the upside is unlimited, but that's, of course, beyond 275. But no matter what Tesla does next, we're guaranteed in the worst-case scenario to make 24%. Pretty much close to 65, 68% of the unrealized 32.4% that we have in the position. Okay, but I want to continue this trade. We know how options work, don't we? Why do I want to sell and talk about the time value decay? We can talk about the time value decay curve, options that are 200 days out in time to 100 days out in time, and we get close to 60 days out in time, and then 30. So the time decay curve of an option essentially tells us what we want to be doing is selling and getting the rapid time decay in our favor. We want to be selling, shorter term. When we're buying, we want to be buying farther out in time because that gives us a lower annualized cost. And as we're selling shorter term, we're getting a higher annualized return. The option that's 5 months out in time is not 5 times the cost of the near-term option. The option that's 6 months out in time is not 6 times the cost. It's linear, so you always get a lower annualized cost for insurance or buying options if you buy further out in time, and we always get the higher annualized premium if we're selling shorter term, 7, 14, 20 days out in time. So I want to stay in Tesla. Got a cost basis of 190. We're currently up to 250, 150. Let's say, okay, we want to go back to December. Let's see what we've got. Let's go out to December. Now, right now I have that unrealized gain of 32.4%. I'm getting about half of that. But with the stock at 251.52, I don't think I'd go as deep in the money as 290, 280, 270. The 260 is about right. Probably the 270. Let's use the 270, 14.8%. But that's less than half of the unrealized gain I have right now. But through December expiration, 168 days out in time, I've guaranteed a profit of 14.8% in the absolute worst case scenario. The minute, if I decided to buy this put, and it is expensive, right? $4,500 if I had 100 shares. But the minute I purchase this put, I'm not down $4,512. I could immediately turn around and sell that put for, $45.05, just losing the bid-ask spread. That's it. I'm still close to that 32% unrealized profit I have right now. But what's going to happen over the next 168 days on this position? We're going to cross an earnings on 7/23. There's no dividend, of course, but think about that. I'm in Tesla. I have a nice unrealized gain on the position. I'm pretty much guaranteeing for 168 days. I'm going to cross actually two. Yeah, we're going to cross two earnings events with a guaranteed profit of half of the unrealized profit I have right now. With what? With leaving the upside open. Okay. But of course, looking at the insurance tool, probably go to August. So that'll cross that July earnings. I'm still locking in about 3/4 of the unrealized profit with reasonable strikes that aren't too deep in the money. 270, 265, 22.7%. Going out to those August expirations, crossing the earnings with no chance of loss and a guaranteed profit. Well, and of course, if you wanted to generate some premium short term before the earnings, let's just add a sell call. Let's see what we do. We're going to lock in some of that profit using that August put. And before July expiration, before the earnings, generate a little bit more premium. And now we have locked in profits 28%, 27%, 25%. Getting a little bit of premium on weeklies, or we could look out the 2 weeks as well through this list before the earnings event, guaranteeing profit using that August put to cross earnings, but getting more premium to further bulletproof the position, further increase potential profits. Let's take a look at this 261 just off the whim. 23.9% guaranteed profit on the position with a potential to match the unrealized profit we have right now of 32.7%. Okay. And that's what we've got. Selling the 260 call for 45. Buying the August 260 put. It's much more expensive because we're crossing earnings and there's some intrinsic value. $9 of intrinsic value, but we're crossing that earnings. That's why it's more volatile, it's more expensive. But guaranteed profit of 24% of the 32.4% unrealized profit we have right now. Still a max profit of 32.7% if the stock is trading above 260 7 days from now. Or at, I should say, 260, but still no chance to lose, guaranteed profit. The stock insurance tool, the opposite of the stock repair tool. From when you have a gain, what positions could lock in guaranteed profit on my position now that this has happened, realizing or locking in half, 2/3 of the unrealized gain if I just liquidated the position, but what? Leaving the upside open in case the stock continues to run, with what else? The ability to do other adjustments against the position because I still own the stock. I've paid for the put. I've locked in a guaranteed profit crossing earnings, and I can increase that by generating premium, selling a call, doing other things. This is all part of the concept, of course, that we talk about in our full course, The Blueprint, that discusses the married put and 12 different income methods. Of course, when we start a married put, we're starting off with a limited risk of 4, 5, 6, 8%. But if you pick the right stock, it exceeded your expectations, rather than just closing out now if you're expecting more side, but you want to be rewarded. You want to guarantee protection. You want to guarantee profitability. Use that stock insurance tool. You can find it under the married put tab as we showed, or under the signature tools tab under the insurance tool to see which puts might give you the best bang for the buck to lock in half, 2/3 of that unrealized profit you have right now, still leave your upside open, and still have the ability to generate income on the position.